Imagine owing the same amount on your mortgage, but suddenly, it feels like twice as much. Deflation isn't just about cheaper prices. It's a silent debt trap that could swallow your financial future whole. Is falling prices really a good thing? Deflation is when the general price level goes down. This means things like groceries and clothes get cheaper. On the surface, this sounds great, right? But it can actually cause big problems for the economy. It's also sometimes referred to as negative inflation. One of the main reasons deflation happens is because there's less demand for things. Maybe people aren't buying as much, or maybe companies are making too much stuff. Technological advancements and productivity gains can also lead to increased supply, which can lower prices. When prices keep falling, people often delay consumption, waiting for even lower prices. This reduced spending makes businesses lower their prices even more, sometimes even cutting wages, and this can lead to lower profits and even business failures. People might lose their jobs, and the economy can slow down or even go into recession. Deflation can also make debt harder to pay off. If prices and wages are falling, but your debt stays the same, it's like your debt is getting bigger. This increased debt burden can lead to a credit crunch where it's hard to borrow money. Governments and central banks try to fight deflation using monetary policy and fiscal policy. They might lower interest rates to encourage borrowing and spending. Or they might increase government spending or cut taxes to give the economy a boost. Quantitative easing is another tool where the central bank buys assets to increase the money supply. Japan experienced a lost decade of deflation, and the Great Depression was also marked by falling prices. These events show how damaging deflation can be. The European Central Bank and the Federal Reserve constantly monitor inflation and deflation risks. While lower prices from increased productivity are generally good, deflation caused by decreased demand can be very harmful. It can lead to a deflationary spiral, where falling prices lead to less spending, which leads to even lower prices. Economists also consider price stickiness and wage stickiness, meaning prices and wages don't always adjust quickly to changes in demand and supply. This can make it harder to get out of a deflationary period. Even with all the research, some questions about deflation remain unanswered. For example, how does deflation affect different sectors of the economy differently? And what are the best ways to prevent deflation from happening in the first place? The long-term effects of prolonged deflation also need further study. If you found this video helpful, please like, share, and subscribe to keep watching more videos like this.